It only trades equity index futures. So instead of making directional bets, it's trying to identify relative mispricings between these equity markets.
Fascinating. I guess now would be a great time to transition into the other strategies that Versa runs. And I remember in the pre-call we discussed a managed futures strategy that Versa runs. It's one of you guys' flagship strategies. And Nishant, I'd love to hear, from your perspective, um, what is that strategy and what are the benefits that it has, or I guess trend strategies. Talked a little bit about how this one demonstrates positive convexity. I would love to hear it.
Really, this strategy came about as a result of our internal research. We were very focused on offering a differentiated product in the managed futures space that really accomplished three main things. First, providing good absolute returns for our investors. Second, providing positive convexity. Convexity is defined in terms of how the strategy performs, particularly in equity down markets, but also equity bull markets. And third was making sure it was uncorrelated with the broader CTA space and the trend following space as a whole, which has the dominant amount of allocation in that investment universe. So this really came about as a result of our focus and internal research on creating something new and novel, and it's something we've been running for 8 years. And we're sort of happy to say it has achieved those things. It displays a tremendous amount of positive convexity, particularly in equity stress periods such as COVID, and it does this in a very unique and different way. So it only trades equity index futures. So we trade 24 equity index futures globally. The second thing it does is instead of making directional bets, it's trying to identify relative mispricings between these equity markets. And so what it's really doing is asking questions around are these is the S&P 500 more or less underpriced with respect to the FTSE 100, with respect to the Nifty, with respect to CACs? And what we found as a result of our careful and long research on the process is that this strategy that looks at and exploits dislocations in equity markets provides all these characteristics, and is a very unique product offering because to the best of our knowledge, no one else certainly does or models and thinks about these things in this way. And one of the main novelties of our approach in the strategy also is it allows us to construct signals from a top-down macro view, where we look at price and volume of the equity index futures. We look at dislocations between cash and futures markets. That's a large part of one of the key drivers of alpha in the strategy, where particularly during times of volatility, you will see significant dislocations between the spot cash market and the futures market as people are trying to hedge exposure. The second source of alpha we have is that we're able to construct signals bottom up from the individual stock level stocks in each one of these indices. For developed markets such as the S&P 500, this is reasonably easy to do, but for a lot of the EM markets that we trade, such as FTSE KLCI, MSCI Singapore, and Nifty and others, this is a very nuanced data exercise. We collect a tremendous amount of fundamental and stock level data for all these companies, and using our modeling skills and insight over the past number of years, we're able to construct these signals from bottom up and top down. And that's what really provides a market neutral, unique product offering that accomplishes all our goals: positive convexity, strong returns, and uncorrelated with the broader CTA space.
If these strategies that you're running are market neutral, how do you think about liquidity? Because I imagine the liquidity in the US markets, I mean, off the top of my head, I imagine it would trump maybe even all the other markets combined. just because everyone trades the US markets and it's the hottest thing right now. How do you think about that?
Yeah, we think about it in terms of risk exposure. So in a portfolio construction space, what you often think about carefully is legitimate liquidity constraints. So in EM markets in general, in the EM equity index futures, there isn't as much liquidity, so we don't run as much risk in EM markets as we do in developed. We run developed as a separate universe to EM. We run 12 developed on a cross-sectional basis, 12 EM on a cross-sectional basis. And it's not like there isn't liquidity. These markets are mature. This is something that we look at on an ongoing basis and constantly looking at the investable universe, carefully measuring transaction costs, checking market liquidity is a constant process in what we're involved with. But really, the secret sauce of trading these things well is having a well-designed portfolio optimization process that accounts for these things in general. Because for systematic investors and quants in general, you know that oftentimes the alpha signals will be strongest in these less liquid, smaller markets. But that alpha is sort of a mirage because you can't actually trade those markets in the level of size and volume you want without moving the prices meaningfully. And so the key insight is incorporating a very thoughtful portfolio construction process that takes into account transaction costs and liquidity in real time to account for the position sizes you take in these markets. One of the things that I like to emphasize, particularly to researchers at our firm, is that the systematic way that we trade and try to find inefficiencies is meant to try and extract global financial anomalies in market data. So what I'm looking for is, so let's take a very simple example. Let's take price momentum, which is a well-established anomaly where things that have gone up tend to keep going up and things that have gone down tend to keep going down. As quants, we're less interested in specific questions as to, oh, is it only working in one country because of specific location or specific nuances. We're more interested in, here is this general effect that is being displayed in equity index futures markets because of the inherent behavior of how equity index futures markets trade. How do you find this effect in as many tradable liquid markets as possible? That's like a differentiation with regards to how we think about it. It's not completely wrong that we don't need insight into the individual securities. So if I'm trading the Philippines, I want to think about what are the dynamics of what's going on in the Philippine Stock Exchange, whether there's any odd or specific behavior that would need to be modeled for, or would suggest that we maybe don't model it, right? So one of the most notable examples is that the way the dividends are handled in the DAX in Germany is different to how it's handled in other equity index futures. And as a result, certain signals will not incorporate because you have to think about those things. With regards to your question about how we go about sourcing data, we've been doing this for 5 or 6 years now. Actually, we've been doing it much longer than that. And so we've spent a lot of time collecting data both ourselves, but then also building relationships with vendors with high trust and reliability that we can utilize from. For quants, building signals from alternative data is an extension of the signal generation process. The things we look for are, is there good coverage? Is it point in time? Is it reliable? And in some of the EM markets, it's not there, and that's okay. But that doesn't mean we're not constantly talking to people, constantly trying to reach out and understand. Or if the situation arises, engaging with a local vendor to potentially collect specific stuff for us over time so that then future us can potentially use that in a meaningful way.
Now, interesting what you mentioned about building those relationships with the vendors, because obviously you guys are trying to get the highest quality data possible, highest quality information possible to translate that into research, into trading edge. And I think that's probably a part of the quant business that I haven't heard that many people speak about. And it's very interesting that you say that.